Everyone, happy Monday. My name is Yanni and I'm on the community team at 1460 Mission Street. That's one of our locations in San Francisco. I'm excited to get today's Lunch and Learn started. Before we begin, just want to remind you to put yourself on mute as you're joining to make sure that we have full attention on our host today. Today we have Joseph Flannery from SELFi.com, who is a member at 1161 Mission Street. So go Mission Street. And he'll be leading us through a session on how to hack your mortgage refinance. Joseph started SELFi.com in 2018, which is a comparison website that empowers and educates consumers to, sorry, I have a dog barking, to save more on their mortgage refinance. He's helped over 1,000 homeowners refinance their mortgage, and he's here today to help answer any personal questions that you need his expert advice in. So I do want to note that today's session is a little shorter in terms of a formal presentation, as we really want to open it up for Q&A as soon as possible and get your specific questions answered. If you do want to learn more about SELFi or want to connect with Joseph after the call, just include your email address in the chat box to the right-hand side so that we make sure to get those emails over to him. So Joseph, floor is yours.
Thanks, Yanni. Hey, everyone. Just hope you're well and staying safe. Really, this is intended for somebody who already has a mortgage. So if you're a new home buyer, some of the terms may not be a fit for you, because I want to get very specific so that you have some insight on how to get a better deal on your mortgage refinance, regardless of which lender or bank that you work with. And so I really define better deal as a lower rate at the lowest closing cost with the least amount of hassle. And really, to start, is the biggest misconception amongst homeowners and home buyers in the U.S. is the role of the federal government. And just to kind of give you an overarching view, basically, Fannie Mae and Freddie Mac were started by Congress to provide liquidity to the mortgage secondary market. So what that means is when you do a home loan, the lender or bank doesn't actually just hold on to the loan and collect the interest from you as the borrower, as maybe they did pre-1940. So what this does is basically the lender will make the loan, and then they will sell the loan to Fannie Mae and Freddie Mac as a mortgage-backed security. And this is the biggest misconception is people think, banks, like large banks, Wells Fargo, Bank of America, they're going to offer me the lowest rate because they have the lowest cost of the capital. But the reality is 90% of the loans that are done in the United States get sold on the secondary market to Fannie, Freddie, or Ginnie Mae. And Ginnie Mae is actually a government entity, and they do FHA loans, VA loans, which are loans for veterans. And so if the loan is going to be sold to Fannie or Freddie, it's really important to think about comparison shopping, even more so than when you're applying for a loan directly from the bank, because it really becomes about operational efficiency and about your ability to broker these loans to the government. So big banks, in effect, don't have as big of a competitive advantage, or really not much of a competitive advantage at all, compared to non-bank lenders. And so this is how non-bank lenders have been able to gain market share year over year on big banks. So this is Quicken Loans, Loan Depot. These are some of the larger non-bank lenders. And so it's really important to know that the loan that you're applying for, whether or not the loan you're applying for is going to be sold to Fannie Mae or Freddie Mac, or who the end investor is, because the loan is going to be underwritten to those guidelines. Another big misconception is this idea that the bank or lender is underwriting to risk. And that's really not the case. What they're really doing is they're underwriting to the investor guidelines. So to give you an example, let's say you have $10 million in the bank and you go apply for a $100,000 loan, but your income is zero. Well, that loan would not get approved with Fannie Mae and Freddie Mac, because you need to have your income verified to qualify. But obviously that's an incredibly low risk loan. So that's just kind of an extreme example where lenders and banks are really underwriting the loan to the investor guidelines and not underwriting the loans to risk. So now just knowing that the loans are going to be sold after it's completed, it really does open the door to now people should compare more, because what most people think is, oh, they know my loan best because I have my savings account with them, or I make my payments to them now, so they're going to help me get the lowest rate. But let's just kind of put that misconception away today, because that's really probably the biggest key and the biggest mistake people are making when they're refinancing their mortgage. So your lender, the company that you make your mortgage payments to, they're actually your mortgage servicer. So what I mean by that is, let's take Quicken Loans, for example. Quicken Loans does the loan for you. They provided the capital for you to get the mortgage initially. They then sold that loan on the secondary market. Let's say they sold it to Fannie Mae. And so really Quicken Loans is just a pass-through entity. So when you make your mortgage payment, then they're going to then pass that mortgage payment on to Fannie Mae. And so the reason why I bring this up is because the large banks and lenders all have a division within their mortgage department called portfolio retention. And what their job is to call all their existing customers, the customers that make their mortgage payments to them, and say, hey, let us help you refinance your mortgage. It's above, certain, whatever it is, you could save some money. And that may be true, but what happens is the customers end up not comparing the rate that's quoted by that bank or lender, and they could have potentially gotten a much better deal had they compared. And part of the reasons why they don't compare is they just assume that the bank and lender that they make their payments to is the one who actually holds the mortgage, and so it's going to be much easier to do the refinance with that company in the first place. But that's not really the case, because the loan then the refinance application still has to meet the guidelines of the end investor, which is either going to be Fannie Mae or Freddie Mac or Ginnie Mae. So don't fall for that trick, because they're emailing and calling and putting in flyers in their mortgage statements saying, hey, we know your loan best and we can help you get the best deal on your refinance. And that's probably the top mistake people make when they refinance their mortgage, is they only get that one quote. So this really kind of goes to what I'm talking about. The key to really anything, getting the best deal, regardless if it's your mortgage refinance or anything else, is comparison and negotiation. So comparison really gives you the leverage for negotiation. You might have a preferred bank that you want to work with, or a preferred lender, and people don't even realize that they can negotiate all the terms with that preferred lender, preferred bank. I'll give you a specific example. I had a client, he refinanced, or he started the application through SELFi.com, and the rate that he was able to get through SELFi.com was about 0.375% lower than what his bank was offering. But his preference was to stick with the bank. So the bank had sent him an offer, and we had sent him an offer, and the offer with SELFi.com was much better. And so he said, okay, I'm going to pursue this. But what he did is he took that offer that we provided him, and then he went to his bank, Chase, and he said, hey, here's what I'm getting through SELFi.com. Would you be willing to match? And they didn't exactly match it, but they came close enough to, he said, you know what, I prefer to have Chase be my mortgage lender, and I'm going to stick with them. And so he was able to get a much better deal with his preferred lender through the comparison shopping. And you'll probably, this is true when someone buys a home or when they refinance, but most people do not compare. And it goes back to that, the first slide of people think, oh, I just going to go with whoever I have my savings account or whoever I make my payments to. But 40% of mortgage shoppers do not even compare. They just go with the first offer. And 70% or 76% of mortgage shoppers don't get a second loan estimate. And what a loan estimate is it's a complete breakdown of the mortgage offer, and it's actually legally binding. So the fees that are listed on the loan estimate can't exceed what's presented by a certain threshold. And so borrowers really know that what they get on the loan estimate is concrete. So if you're ever going to evaluate a mortgage offer, the document that gives you the best understanding or the breakdown of that mortgage offer is the loan estimate. So comparison and negotiation are really the key to getting the best deal on your mortgage refinance. And